It is our investment decisions that decide our financial destiny. If Warren Buffett had not taken the catena of right investment decisions he took, he would not have become the richest man in the world. If our investment decisions turn out to be right, we reach our financial goals. If they turn out to be wrong, we fail to reach them. However, most of us adopt a lackadaisical approach to investment decisions. We tend to take investment decisions impulsively without doing adequate homework. The result is that we damage our own financial future. Before proceeding any further, I would like to draw your attention to the old proverb, which says that only Brahma can predict the future, can foresee the future. When you try to work out how an investment will do in the years and decades to come, you are trying to predict the future. And nobody can predict the future with 100% accuracy. For example, the Third World War can begin tomorrow and upset all our carefully made calculations. Having said that, I would like to state that not enough emphasis can ever be given to the evaluation process. Using the limited resources at our disposal, we have to carry out a thorough evaluation of every potential investment, and based on that evaluation, we have to come to conclusions. It is only when the evaluation gives us satisfactory results that we should decide to take that particular investment decision. The first input that has to be factored in is the investment amount. Is it 1 lakh or 1 crore or somewhere in between, or even more than 1 crore or less than 1 lakh? You have to decide that. The second variable that has to be taken into account is the time span. How long do you want the investment to be an investment? Is it 10 years or 20 years or more than 20 years or less than 10 years? You have to take a decision on that. The third variable that has to be taken into consideration is the annual gross return on investment. Suppose you are buying a house and planning to rent it out. What will be the expected gross rental income per year from that house? That is the annual gross return on investment. What is the taxation on that income? If that particular income is added to your total income, will that lift you as an assessee to the next income tax slab? If so, what will be the consequences? Will you have to pay TDS on that income? Will you have to pay GST on that income? You have to look into these matters. For example, income from a residential building, rental income from a residential building is treated in one way, and rental income from a commercial building is treated in another way. The term operating costs is seldom used in this context, but I think that's a most appropriate term. Any investment is bound to have some operating costs, though in certain cases it may be negligible. If your investment is a building, some maintenance will have to be carried out every year. If your investment is a flat in a society, you will have to pay society charges every month. What is the total operating cost of your investment? You have to work it out by reducing the taxation on the income and the operating costs from the annual gross return on investment. You get the annual net return on investment. This is the final amount that comes to you from your investment every year. The final amount that reaches your pocket after all that has to be taken away from it are taken away. Every schoolboy knows that 1 rupee today is more valuable than 1 rupee 5 years from now. $1 today is more valuable than $1 5 years from now. Hence, in order to calculate the present value of an investment, we have to subject future cash flows to a discount rate. Future cash flows have to be discounted because they are not what they appear to be. This discount rate has to be fixed, taking into account all the necessary variables, including the inflation rate and the opportunity cost. Only after subjecting the cash flows from your investment to an appropriate discount rate will you be able to arrive at the real value of your investment. The final gross value of your investment is the final value that you get, the value that you get when you decide to end the game. For example, if I buy a commercial building for 5 crores and hold it for 10 years, getting rental income from the building all through the years, I may be able to sell it for 10 crores. So 10 crores is the final gross value of my investment. In the case of a fixed deposit, the initial value and the final value are the same. If you deposit 5 lakhs in an FD account and you accept interest every month from your bank, at the end of the deposit period, you will get exactly what you deposited at the beginning of the investment period, that is 5 lakhs. No wonder financial analysts are unanimous in calling fixed deposits wretched investment. If I sell my commercial complex for 10 crores, I don't actually get 10 crores. For one thing, 10 crores at that point in time is not, certainly not, 10 crores at the point of time when I begin my investment journey. So, that amount has to be subjected to a discount rate. For another, there will be taxation. For example, there could be capital gains tax. So it is after subjecting the final gross value to an appropriate discount rate and after deducting the necessary taxes that I can arrive at the final net value of my investment. This is the last variable to be taken into consideration while carrying out a holistic evaluation of your investment.